Forget Hamlet. If you ask general partners what the real tragedy is, it's fundraising. On an absolute basis, it was still a strong year, with estimates hovering between 1.5% and 2% of the MSCI world market cap. However, fundraising is down for the second year in a row and down around 35% from peak levels. If you dig in further, it's not surprising that most fund strategies are seeing a decline year over year. But pay attention to the deal side, as the number of direct transactions has meaningfully ticked up, a sign that GPs are more willing to partner to alleviate both their own capital needs and defer the day they need to come back and fundraise. Taking a look at the trailing 3-year fundraising periods, equity-focused strategies are now retaking market share, reversing a 15-year trend. On a geographic basis, and compared to a decade ago, what's shocking is how little market share has changed by region. And this is over a time period when the industry has almost tripled. Let's look at fundraising by fund size. Remember all those people who said the larger the fund, the worse the returns? Well, it turns out that large funds weren't all that bad. The big keep getting bigger, and that, pray tell, is largely due to long-term strong performance. But Hamilton Lane, that can't be true. Small funds all do great. Well, actually, from 2000 to 2020, smaller funds have had a much higher risk and reward. It's an area where selection is critical. Mid-market funds offer the most attractive risk-adjusted returns since 2000. That being said, large-cap funds offer a more compelling risk-return trade-off should a downturn hit. This was especially evident if you look at the data from the vintage years leading up to the GFC. Our prediction? The industry will continue to be dominated by the larger players, even in this tough fundraising environment. As we've always said, size and scale matter, and the big will continue to get bigger.